level, it still is not. And because the GSEs are federal institutions and they do not accept employment or income from anybody who's deriving that income from a cannabis-based industry. So there can be some interesting things that happen with that. Niche products, we'll start with the one that many people have heard of. It's a bank statement program. Typically, you're looking at a 12 or 24-month bank statement program. There are some additional options that are out there. It's on a case by case, and it really becomes very nichey with our investors. We have had instances where we can do 1 month, 3 month, and 6 month bank statement programs. Traditionally, they want to see that you're using either business bank accounts or personal bank accounts, but there are cases where we can use a mix between both business and personal bank accounts. Generally speaking, your purchase loan to values are up to 90%, cash out refinances and rate terms are up to 80%. Okay, minimum FICO, your most aggressive out there has got a minimum FICO of 600. That's not everybody who's out there. The next program is our non-QM 1-year self-employed. This one's kind of interesting. It goes up to 80%. It can be used for purchase, refinance, cash outs. Minimum FICO on this one, because this is investor specific, is 660. The income qualifies with only their most recent 12 months bank statements and the previous year's W-2. Okay, and they must be in the same line of work. Traditionally, your bank statement programs and other programs want to see that you've been in that same line of work for at least 2 years. So this is one for somebody who has recently transitioned into being self-employed. It can be a real saver. There's another couple programs that we'll touch on as we go through this farther that also cater to somebody who's recently had a change in career.
So basically, let me just recap here briefly there, Lauren. So with the bank statement loan, you're just basically showing them your bank statements from anywhere from 1 month to a year, and they're approving a purchase off of that.
Yeah, so there's a couple of different ways that they'll do them, Randall. What they'll do is they'll look at the bank statements. Some of them only want to see the first page of the statement to see what goes in. Others want to see the entire statement. So keep in mind that when you're working with non-QM, it's not as homogeneous and consistent as is the agency Fannie Mae, Freddie Mac, FHA, VA, and USDA. Okay, it really does vary from investor to investor because these are non-portfolio or non-QM funds that are out there. So we do see a lot of guideline differences between each of the investors' programs. Now, some of them are similar, but you will get some outliers as well. Some of them want to see the complete bank statements, and they'll go through all of those bank statements and look for all eligible deposits. Then they'll look at it and say, okay, this one doesn't seem to be consistent with what everything else is. We don't like that one, and they will on occasion throw some of those out. They do have NSF requirements. Typically, they don't want to see more than 4 NSFs within a 12-month period, although there can non-sufficient funds. So if somebody bounces a check or overdraws their account, that tends to be looked at in a negative way. Although there are some exception-based programs where if there are other compensating factors in that file, then you can get those through. So some will look at just the first page, Randall. Others want to see the entire statement, and they all have different ways of calculating what that net income is coming off of that. Some of them will allow for transfers between accounts. Others will say, no, you can't transfer money from this account into this one and have it count. These have to be straight deposits that come in. Your P&L program, this is a little bit of a play off of the bank statement program. And with this one, they want to see just the first page of the bank statement reflecting the company name on the P&L, and you have the CPA who provides your P&L. This
profit
one
and
can
loss
be
statement. We probably have to. We
Sorry.
have some newer agents. We probably ought to explain a few of these.
Right.
Yeah.
So you qualify off the P&L or profit and loss, nothing more, nothing less. Okay. So this one's very straightforward and simple. Either 12 or 24 months, your purchases go up to 90%, cash outs up to 80%, loan amounts can go up to $4 million, and minimum FICOs on this can be as low as 600. Keep in mind that on these non-QM programs, interest rates are going to be higher than agency, okay? And they're typically going to be anywhere between 200 and 300 basis points on average, higher than what a regular Fannie Mae, Freddie Mac loan will be. Some of them have prepayment penalties, not many of them do though. Okay, so this is one where we really find that we're spending a lot of time looking at different investors' guidelines as we look at a scenario for a borrower to see which one's going to fit them the very best.
It looks like it goes up to 4 million, so that's,
yes,
you know, that could be useful for, you know, some jumbo size loans.
Absolutely. This one is our DSCR, or debt service coverage ratio loan. It's considered to be a business purpose loan. This one is only for non-owner occupied property. So this is investor, okay? There's no personal income that shows up on the application. There's no employment and there's no DTI that's calculated. On this one, they simply take the cash flow from the property or what the rents are, and then they look at the payment and you qualify based on the cash flow or the rents on the property. Your DSCR scores go anywhere from, they like to see them at a 1-to-1. So if your house payment is $2,000 a month, they want to see at least $2,000 a month in rent. Some of them are at what we call a 1.25 or a 1.5, which means that if your payment was $2,000 a month, your rents would have to be $3,000 a month. But we also have some that will go all the way down to a 0.5 DSCR, which would mean theoretically that if your payment was $2,000 a month, your rent could be $1,000 a month. Okay, so it's kind of crazy with some of that they'll do. Short-term rentals or Airbnbs are okay. Maximum loan to value on these, it's traditionally 80%. There is not a limit on the number of properties that you can have financed. Now, Fannie Mae and Freddie Mac do have limits on the number of properties that you can finance. It's 6 and 10 properties respectively. This doesn't have any, and you can also vest these in an LLC. Okay, these are also available in 30-year terms. There's also a 40-year term available, and you can also do interest-only options on them as well. They're available in both fixed and adjustable rates too. Gift funds are also okay on these. The cool thing about these, yes, you can use gift funds on some of these. Okay,
Awesome.
Condotels and non-mortgable condos are also okay on these. So this is really, yeah.
I would say, it sounds like this one would be a good opportunity. Like, let's say you're working with somebody who buys well, I've got one, we've done here. So we bought a 5-plex, and it's run down because it hasn't been updated in 40, 50 years, right? So we come in with this one here, we purchase it, we increase the cash flow on it, and then you move over to a loan that might be a little bit cheaper. Is that correct? By correct assumption?
Yep. This works well for a lot of people that don't want to, either they've maxed out their ability to finance properties from a traditional standpoint because of qualifying ratios. Okay.
Yeah.
Or it's also a lot of real estate investors will use these because they don't have to uncover all of their finances. It can be very simple and straightforward. Also, a lot of real estate professionals have used this. Some clients of mine, even the ones that are making a lot of money, don't want somebody looking into all their documentation, and they just don't want to be bothered pulling together all of the documentation.
Yeah.
So they've said, give me the path of least resistance. Okay. Get me to closing as fast as we can. What's an option? I'm okay paying a premium in rate. I know the property's going to cash flow, and that's all I care about.
I wish I had known about some of this before, because I did a home equity line, and it was a mountain of paperwork. And they're like, I said, the house will be, paid off. And they're like, well, we can't see how you can pay it off, right?
Yeah.
And they don't see what I'm seeing. I send them bank accounts and everything else, but the way they look at it is totally different. So I said, here, let me make this easy. And I just paid it off.
Yeah.
And, and then they did it, but it was a huge amount of hassle. So I can understand that.
And what happens on that, the reason for that is your second mortgages, your HELOCs, or second position or junior liens. So if something happens to the client, then they're in the position behind the first. So if they go into default, many times that second mortgage, if they want to, reclaim their equity, they have to go take out the first.
Yeah.
And that can become an expensive proposition. So you don't see equity lines or home second mortgages with no doc or bank statement programs. Those are all full qualifying loans it's how they underwrite them. And it's always been that way. This one's a really interesting one. This one just came out literally within the last 12 months. It's been extremely popular. This program is geared towards serving underserved communities, okay, is how it came out. And it was a community development financial institution program, or CDFI is how it was rolled out, but it was made available to everybody. So even though it's geared towards underserved and minority communities, anybody can use it. This is a true no income, no employment loan. Okay. There's no income that goes on the application, and there's no employment that goes on the application. This is based strictly on down payment and reserves. Okay. Very, very popular. There's no verification of rent required on owner occupied properties. You can use this as a purchase for rate term, and they'll also do it for cash out refinances. Gift funds are okay for down payment and closing costs as well. Okay. Any assets that you have, you only need to season them for 30 days. So this one has actually become very, very popular lately, and I've had a number of clients who've used this one. Rates on this were up in the 7s on the ARMs. They went up as high as 8s and 9s on the fixed rate loans. And the clients who are looking at this, again, they have the income, they're making it. It's just not a traditional way that they can show it. And they've got cash behind them, and they're like, I don't care. This puts me into a house. I love this program. And this one is a very simple, very straightforward program.
So it seems like this is similar. So back in 08, 09, one of my agents was struggling with clients not being able to get loans that had an I-10, like an I-10, type loan. It looks like something like this would been, perfect. I think we did the seller financing route mostly and did probably 60 or 70 of those with her, but over a few years. But something like this would, like, if you have somebody who may not have clear documentation. So for example, the guy that cuts my lawn, right? He's like, Randall, can you help me buy a house? And I'm like, sure. How much money do you have to put down? And I'm thinking this guy's going to have like 5 or 10 grand. And he says, I don't want to use all of my money, but I could put down about $80,000 or $85,000. And, that's a considerable amount, and so he was able to get into a home, with that, $400,000 home. So it's,
Yeah.
sounds like that would work. It's surprising who has money, really, because I've sold to that crew of landscapers and whatnot. I may have sold 3 or 4 homes, and
Yep. Without question, this is one, and there's also some I-10 programs as well that we'll get to as we move through this. There's also some things for foreign nationals as well. This program here is literally anybody can use this. Okay, I've got clients who have used this to refinance and cash out and pay off bills, right? That are, again, their income is not very traceable, but they're making it. Okay, and they're like, again, this works, and we've been able to improve cash flows with this. What this does right now in a transitional market is it really presents some additional opportunities for people. This isn't intended to be a lifelong loan, although it can be. It's really looking at different ways to help clients who may be in a pinch right now and just present opportunities to them so that they don't feel that things are completely hopeless. Okay. You'll also see some of this starting loans like this if you have somebody who's having a hard time making payments. Hopefully before they get to a place where they start showing them as late payments on the credit report, this would be a wonderful program where they could also go in with no income, cash out, get their debt loads back under control. Okay, pay off revolving debt, pay off installment debt that's making it difficult for them, and then get that mortgage back on the right track so that they can keep the house. Right now, consumer credit card debt, we hear that everybody's doing well and that the consumer is still resilient and that the market's doing well and everything is okay in the economy. But right now, consumer debt is at the highest it's ever been in the history of the country.
yes.
Okay. It's just, and personal savings is at the lowest level it's ever been.
I think I
So
saw an 80% drop in personal savings, and the credit card debt was up over $1 trillion.
that is correct. Yes. So the spread between those two numbers, the last time that we saw a huge spike in credit card debt, the highest it had ever been was leading up into 08. And through that, we have blown through that level at this point. Okay. And if you look, the only other time that people actually had money in their bank accounts was when, again, this is talking about averages, okay, and the population at large. Obviously, it does not apply to everyone. But if you look at when they had stimulus, then savings went up. And then that peak went right back down. And then the stimulus, and then it peaked back up, and then it went back down. And now there's been no stimulus. So you're looking at savings each and every month continue to decline and decline and decline. And the way that people are continuing to spend, the way that people are continuing to pay for Christmas and holidays traditionally and typically right now is on credit cards, as evidenced by the ballooning credit card debt that's out there.
So I've got a few questions, but I'm recording this, this far in and that, but one was, it says, so bank statement loads needing 10% down and non-QM is 20%.
So non-QM is a broad spectrum term, which means anything that's not a qualified mortgage. Okay. So non-QM is anything that's not Fannie Mae, Freddie Mac, FHA, VA, or USDA.
Okay.
Everything outside of that is what we call non-QM. And within the non-QM space, there's a number of different loan to values that apply. Loan to values are also based on credit score. All right. And they can also be predicated on property type as well. So that's why I say there's not one homogeneous set of guidelines that apply to the non-QM space. Okay. And if we were to go dive into each of these different loan types, we could pull up 12 different investors, Randall, that offered them, and you'd see different guidelines between each of them as well.
Okay, perfect. I'm recording this, so I'll send the link out to everybody that I put an email in there for William. If you email William, I'll have this sent out for you afterwards, and then you can contact Lauren as to the specifics on each loan program.
Yeah, and that's really the best way to do it, because then we can start looking at different ways, and start running scenarios and comparing it to the different investor offerings. And so it ends up, it can be a lot of legwork, but it's also something that becomes very rewarding, because it's not simply oh, you have this, then it's a this. Your agency programs, which we call the steady eddies, or the, milk toast type of products.
Yeah.
They're pretty straightforward. You know that your maximum loan to value on an FHA loan is 96.5%, no ifs, ands, or buts, right?
Yeah.
And so you can go through it that way. Where the non-QM space, because these are not regulated by Fannie Mae, Freddie Mac, or the agencies, you do get different levels of guidelines and different programs that are out there.
Looks like you can almost qualify anybody that has like a 600 FICO, it's between 6 and 7.
If you've got cash reserves, okay, and you've got money for down payment, you literally can, for the most part, almost anyone, okay? Then it becomes a question of affordability and the client's comfort level with the payment. And that's an important one, right? Because it's one thing to be able to get somebody a loan. It's another thing that's for somebody to be comfortable making that payment and to be confident that they can continue to make that payment. Because doing anything short of that, in my opinion, becomes premeditated foreclosure. And that's not what we want to do. And that's not responsible either. This is about doing more than simply putting somebody into a house. It's helping them get into a house, or helping them get the financing that they need for the long haul, right? It's really about creating additional family wealth and generational wealth for people, and helping them manage their finances. Because right now in the US, we are historically bad at managing finances.
Yes.
It's as evidenced by credit card debt and savings rates.
Well, it's kind of like being a doctor, that realtors and mortgage people should have the same ethos, do no harm, right?
Mm-hmm. Yeah, exactly. This is your I-10 program. This is the one that you were talking about, Randall. And an I-10 is an individual tax ID number, okay? So this is somebody who does not really have, they may not be a citizen of the US, but they do have an individual tax ID number. So they're not eligible for traditional financing and other aspects, but there are I-10 programs that are out there. These ones are available both on full doc and bank statement options. You can use them for owner-occupied, second homes, condos, townhomes, and manufactured homes. I-10s typically do not do non-owners. Okay, that's much harder to do. But again, there are some niches out there. Max loan to value is 85%, and then cash out refinances go up to 80% as well. This one can, yeah, go ahead.
Go ahead. I was just saying, I just had a question here, like a second home. So that's still considered owner occupied.
In essence, yes. Yeah. I mean, traditionally, yes. It's I know some people will rent out their second home part of the time. All right. Yeah. The legality of what people do on that, I'm not going to dive into that one.
Right.
But yes, it traditionally is still considered a second home.
Perfect.
Okay. This one, they're out there. We don't see a ton of these, but it is a good program to have. Again, the The important thing right now is being able to present a number of different options to clients, and rather than just hearing a scenario when somebody tells you something and go, oh, that's not going to happen, being able to say, you know what, there might be something for you. Let's take a look at this thing and at least explore some possibilities. This one is a 1099 income loan. Okay, this one's different from everything else that we've talked about. This is for underserved self-employed borrowers, a lot of freelancers and contractors, gig economy, et cetera. Your maximum loan is 300 or 3 million. Your minimum is $150,000, and there's no tax returns required on this one. Okay,
Wow.
so this is a little bit different from a bank statement loan. This works off of 1099. So here's somebody who can show that they have a history of making 1099 income, which again really becomes more of a cash flow based loan. Okay, and this one can be very popular as well. Not a whole lot to it. Owner occupied second homes and non-owner purchase, cash out, and rate term. So this loan in and of itself will cover literally everything that a self-employed or 1099 employee would have to do. Really, a 1099 is going to be your independent contractor. It's not an employee. So your year-to-date earnings are verified from an earnings statement, a pay stub, or bank statements. So that's how they go about showing year-to-date to make sure that the year-to-date income is consistent with what we've got in the 1099s from the year before. A very simple, very straightforward loan. Again, this one's become very popular, and this has saved a lot of deals for people as well.
That's awesome. I had no idea there was this many different niche, loans.
Yeah, and we're still going. Okay, we're about just over halfway through them. Asset based. Okay, here's one that if somebody's got a lot of assets, you can actually qualify for a loan based on assets. Now, Fannie Mae and Freddie Mac do have a program that you can use for this, where you can take a sizable asset account and turn that into monthly qualifying income. Some of your portfolio investors also offer it, but there's also a huge number of these that are done in the non-QM side as well. And this is designed for a borrower who has little or no, basically limited traditional sources of income, but they have substantial liquid assets. The way that you qualify these varies, and depending on whether it's a Fannie Mae, Freddie Mac, or whether you go on the non-QM side. So that's why I say there's not one single way to do these. Okay, that's why we really start looking at all the different viable options that are out there. But if you have a client who says, I don't make a lot of money that I can show, but I've got $1 million sitting over here in these various accounts, okay, or 500 here, and I make a little bit of money. There's a number of different ways that we can go about looking at those and making those calculations to still make a loan work for someone.
What about gold? Like I've got a client with maybe 200 ounces of gold. Is that considered a liquid?
Yeah, not you. They'd have to convert that into a brokerage account and actually have it sit as cash.
Okay.
The other thing on some of these programs, when you're looking at bank statement programs, for example, crypto funds will not be, they won't use them. Okay, if you've got crypto funds, you've got to sell the crypto asset, put it in a bank account, let it season, and then it can be used. But using something directly from crypto on these type of loans doesn't work, and that's in large part due to what's happened with respect to the crypto markets and FTX, et cetera.
Okay.
Lauren, I got a quick question.
Yes.
Any advice on potential borrowers that might need to work on credit?
Oh, you stole mine.
When you say work on credit, what anything specific?
Do you have somebody that does credit repair?
Yes, I'm speaking because I have the same question as Jeff.
I've got some people that we can introduce them to that really work in that credit space. I don't do credit repair. Depending on what they need, I can make recommendations on what they need to fix on it or what will help improve it. But if depending on what you're looking for, then there are some people that we can refer them to.
Awesome.
Sounds good. Thank
you. Foreign nationals. Okay, so this is somebody who's not an I-10. This is somebody who lives outside the country and may or may not have a visa to work here. Traditionally, they don't have a visa to work here, but they want to buy property. Okay, this one, your credit scores are higher on this, or we can pull a foreign credit report. Your down payments are significantly higher on these. 25% down for a purchase. Rate term is 70. Cash out is 65. Although you can use these for all three property types. So owner occupied, second home, and investment properties. First time investors are allowed. You can do these loans up to about $3 million, and you can also do these as a DSCR program as well. So literally, it's, you can, in today's marketplace, you can find a loan for good credit, medium credit, bad credit, okay, or not prime credit, citizens, ITINs, foreign nationals, almost anybody that you come across, okay, in some way, shape, or form, there's a program that's designed to fit them, okay? Now, do they have everything that it takes to qualify for the program? Maybe, maybe not. But just because you hear of an off-colored scenario or somebody says, oh, but I've got this and this and this, don't think that it's something that can't be done, okay?
Sure.
It may be something that takes a month or 2 or 3 or 4. I've had a couple that we've had to work on them for 6 months, but we do get them across the finish line, and it's not working on them for 6 months while they're in process per se. It's getting everything in line so that they can actually do it.
So what's good about this is, if you remember, I talked about throwing a big net. It allows you to qualify a lot of people that maybe you wouldn't think would qualify initially. But like foreign nationals, if you have connections overseas, like I lived in Europe for 10 years. I was just talking to one of my friends from Spain this morning. There's people there that want to buy property in the US. There's, if you speak language, if you speak Chinese, like I've got a Chinese agent that's closed a lot of transactions with Chinese people, or, from different places in the world. And they have money, and they have, there's a lot that have money, but there's a lot more that would have 25 or 30% down versus coming up with the whole purchase price in cash. That could be a potentially whole new income source or revenue stream for you as an agent, is focusing on people that are outside of the US that meet these criteria.
Mm-hmm. Absolutely. Here's where we're going to get into some stuff that's a little bit more nichey. This is one that's not, these last couple that we're going to talk about aren't very popular. Most people have not heard about them. Some have. The first one's a cross collateralization program. This is different than a bridge loan, okay? On a cross collateralization, this allows your client to use the equity in their current home, and they can purchase or construct a new home by obtaining one loan against both properties, okay? And what this does, when the existing property is sold, then it's paid off and they can either re-amortize the new one, okay, or they can refinance the new one. Again, there's only a few lenders who offer this one. This tends to be something that your higher net worth clients like to utilize because they understand the value of time and money. And this is one that they're not akin to saying, oh, I'm afraid to use that. A lot of higher net worth, more financially savvy clients who've been around the block a few times, they'll like to look at one of these programs. And these can be very good as well. It also, the benefit to these, Randall, is that it cuts down on the delay that you have. So you can also be in a position where you're not writing contingent offers either, right? It's boom, here we go. Now you do need equity positions on these. If somebody's only got 10 or 20% equity in it, it's not going to work. Okay, but right now with the increase that we've seen in values in Utah, this does work more often than not right now.
People are more equity rich now than they have been in the past. Yes.
People right now, generally speaking, across the US, people are more equity rich now than they ever have been in the past. We're sitting on a higher degree or amount of equity now than we were in 08. We're literally equity that people have trapped in their homes right now or in their homes is the highest it's ever been in the country right now. So that does also present some options for us too. Okay, this is one that very, very few people are familiar with. Okay, it's a GPM or graduated payment mortgage. This one is really for a client who understands finances, understands what they're doing, understands they like to manage their money and they're okay with taking on a little bit of risk, but they also know how to manage risk. Okay. This is not something that I would ever recommend for a first-time home buyer. This is not something that I would ever recommend for the first-time move up. But if you have a client who says, for example, listen, I want to do this. I'm looking for different options. I don't need just a regular loan. Tell me what's out there that we can get a little bit creative on. Okay. A GPM is a regular 30-year fixed rate loan. This is not in the agency side either. Okay. So this falls into the non-QM side. what happens here, the loan is closed and it's locked at a certain interest rate. And then through the first 5 years, the payment starts out lower. Okay. And each year the payment increases 5% until you reach the note rate. So in the first couple years of the loan, you do end up with, or you can end up, I should say, you do end up with negam. Okay. Meaning the payment that you're making is not covering the entire payment that's due. So there is interest being added back to it. This is one of the reasons that a lot of people shy away from this. Like, oh no, I've heard about those. I know that killed my cousins in 2008.
Right.
This isn't a loan for somebody who just wants vanilla. Okay. This is a loan for somebody who says, I'm looking for the best cash flow I can get. My earnings are going to go up over the next 5 years. This is going to happen. This is going to happen. What other options do you have beyond a regular 30-year fixed rate conventional loan? This would be that particular loan. The savings that they actually have on this over the first 3 to 5 years is significant as well. So about year 4 is when you get back to making payments and really chomping down on the equity and the interest that's due. By the end of year 5, you're going to have a small amount of interest that's still deferred on it, Randall. But this would be an example of if somebody was to purchase a home, get it at or below market, and they got a good deal on it. Okay. And they're like, I'm cash flow. I'm looking at cash flow here. What can you do that gives me that? This would be a program that we would look at for that.
So I'm looking on the bottom, I can barely see there, but does that say primary residence only?
Primary residence is only, and loan amounts up to $3 million.
So the primary residence could be a fourplex, right? You live in it?
Yeah, maybe. Maybe.
Okay. I was looking at this, I'm like, okay, maybe, or, 'cause I could see this, again, where you've got something where you're going to force appreciation by remodeling the property, bringing it up to standard, and then
Yeah.
renting it out. So
The thing that has made this attractive for some clients is that the increase in payment is predictable. Okay. They know what it's going to be. So unlike an ARM where you're tied to the market and it can be, there's no way to predict what it's going to be other than the cap that it has on it.
yeah,
This one, they know exactly the payment's going to increase 5% this next year. And next year's after that, it's going to go up 5% again. And after that, 5% again. So that's one that they can budget for and it becomes very predictable and stable.
and that's nice because I had one loan out that was, my payments went from 600 to 1,200 over the last 6 months on it, and I finally just paid it off last week. I was like, this is nuts, but
Yeah.
yeah.
This one's really not so much a niche one. This is just to recap it all. Down payment assistance, buy downs, and low level pricing adjustments. So your DPAs and buy downs are available on conventional FHA, VA, and USDA. You've got grants, which are state, city, local, Chenoa, Utah Housing, et cetera. Buy downs, your 1-1, these are your temporary buy downs, 1-1s, 2-1s, and then your 3-2-1 buy downs. Okay. And then loan level pricing adjustment waivers for first-time home buyers. This one has come out recently, and there's a screenshot I think I did on these. If you're at or below the area median income, then the loan level pricing adjustments that Fannie Mae and Freddie Mac put to loans don't apply to you. Okay, so if you're a first-time home buyer, this can save somebody between 0.5% and 0.75% in interest rate. So this one can be powerful. Again, and there's also some places where you can go to 120% of if you're below area median income in the higher cost areas. It also works in some of the rural areas as well. Okay. This one, again, it's not so much a niche, but it's just something to be aware of, that this does also exist out there as a way and means to help your clients qualify and buy a house. Okay. And make it more affordable.
Yeah, that I was going to say on the grants, what are you seeing for grants?
I haven't done a lot of work with grants, just my clients haven't needed them. And when we've looked at them, and grants, if it's a city or a local one, you've got to check with them because they get used up fairly quickly and they can be there today and gone tomorrow. But there are grants that are out there, and it's really, you just have to call the city and say, what do you have available? Okay. The Chenoa one, that's one that we've all heard of. That's out there. That one lives on. That one's there. I have used those. There's another that's like a Chenoa that we've used a lot of as well. That one's out there and it doesn't go away like your local city ones. Those ones, because they've got limited funds available, can disappear literally overnight.
Yeah.
Okay. This is one that not many people have heard of. It's the Utah Veteran First Time Homebuyer Grant. It's $2,500. If they have been discharged from service within the last 5 years, and if they are a first time homebuyer, they can get $2,500 given to them to use on their loan. Okay, that's it. Use it for closing costs, use it for whatever they want. This one is offered through Utah. It was the state legislature that came up with this one. Again, it's a good one to know about. Simply, if for nothing else, it's a way to open the conversation with a veteran client that you have. They may want to use it, they may not, but it's also one that if you tell them about it, what I do find with veterans is they're more than happy to take information and new things that they've learned, and they will tell every veteran that they know about it.
Yeah.
Okay. They love to share information. And if you talk to a veteran or if you have veteran clients, they also know that the veteran home loan benefit is underused. They understand and they know that most veterans don't use their benefit. So when they hear of something that can help a veteran, they will tell every veteran that they know about it.
That's absolutely true. I've never used mine.
Randall.
Yeah, and my house is paid off now, but yeah, I should have. It would have been good, but you're right. I talked to my squad, the guys that I was in the service with, a couple times a week, on Facebook or over the phone. And so, yeah, we do share information, and so, yeah, that would be a good one. That'd be a good conversation opener, like you said, if you're, working with veterans here or Hill Air Force Base, anywhere up in that area, and say, hey, there's a $2,500, home buyer grant. And
Mhm.
I mean, there's a lot of things that you can talk to veterans about. Like the sad thing about the military is they move you around every 3 to 5 years, typically, and you end up getting out of the service with a retirement that isn't that great because you don't own any real estate that's been building up value over the years. And so I have actually done maybe 4 or 5 transactions with some officers in the military and said, look, hey, do you want to, end up having to work at the local, rental yard or whatever? Because I talked to a colonel who retired and ended up having to work at like ACW rents, renting, backhoes and other equipment out because his retirement didn't quite stretch.
Mhm.
And I said, let's buy some property. Let's buy some rental property. Let's build up a portfolio. So
The other thing that I've found in talking with veterans is there's a lot of misinformation out there on the VA home loan benefit. And the VA program is one of the programs where there are also a number of different overlays that are out there that are put, and an overlay is additional restrictions that are put to a program that are lender specific. And on the VA program, there's a lot of overlays that are out in the marketplace. Okay. So if a veteran talks to lender A and they're told one thing, and a lot of times they'll hear, oh, you don't qualify, or no, this doesn't work for you. In talking with veterans, they'll shut down and they'll say, yeah, my friend was told no, or that he couldn't buy a house right then, and he just gave up completely. And it turns out that in many cases, not all of them, but many cases, if they continued that search, then a lender that doesn't have those same overlays or who knows the program better, okay, they're able to qualify. And I've seen that happen a number of times. And I've also, in my conversations with veterans, had them tell me that very same story. If only I'd known this 3 years ago, okay?
right.
If my friend, what you told me would have worked for my friend, but he just stopped doing, he just gave up on buying a house and thought he couldn't do it, only to find out that he could. So it is very important. If, the old, if at first you hear no, right, try again.
Yeah.
There's no harm in getting a second, a third, or even a fourth opinion, okay? Because this is a program, if you look at the VA handbook, it's deep and there's a lot of information in there, and there's a lot of things that most people don't know, okay? VA loans don't have a DTI requirement. There's no qualifying ratio of 2941. Pick up the phone though and talk to lenders around this valley, and they will tell you that they have qualifying ratios on VA loans. VA loans are based off of residual income. So you can literally have somebody that has a 55% DTI, a 60% DTI that still meets the residual income test on that loan, and they can qualify for that house. And yeah, so, but if, again, most people think that on a VA loan that you have DTI requirements. They don't. The VA handbook, the VA doesn't have any DTI requirements. The VA works off of residual income, but lenders put a DTI overlay to the program because that limits and mitigates risk for them. So that's why it's important to get second opinions.
So tell us the difference between DTI and residual income for those of us that are neophytes.
So DTI is you take your income and the house payment, and that's what your front ratio is. Okay. So many times,
right?
Debt to income. Yep. So many times you'll hear that your debt to income for the house can't exceed 29% or 35%. Okay. Just to use some numbers that are floating out there. Then you've got your second number, which is your bottom number or your back number. Okay. So typically you'll hear it referred to as top and bottom qualifying ratios or front and back qualifying ratios. And that's debt to income. So how much of the house payment does it take up of your income is the front ratio. The back ratio is the house plus any other debts that you have. Okay. And those on a traditional loan, on a Fannie Mae, Freddie Mac loan, they'll go to on average 45. On FHA, you can push those above 50%. If you've got other things going on in the file, generally the old rule of thumb that we used to have if you were doing a manual underwrite way back in the day was that your qualifying ratios would be 29% of your gross income could go towards the house, and a maximum of 41% of your income and other could go towards your house plus all of your other debts. The VA says we don't care about the front and back or the top and bottom ratio. We only care about the residual income calculations. And what the residual income calculation with VA does is it takes your house payment, so principal and interest, plus property taxes, plus homeowners insurance, and says that's the number. Then they take into consideration your other debts that you have. Okay, so car payments, credit cards. They also look at what the proposed utility payments will be on the house because they take us the square footage of what the house is going to be, and there's a factor that we put to it.
Sure.
We add up all of those numbers, and then down at the bottom, then we divide that back into what your total income is. And if your residual income, for example, is 120%, okay, of what the house payment is, which again can leave you with a debt to income ratio of 60+%.
Right.
Okay, you still qualify for that loan. So the VA, if somebody says that VA has qualifying ratios, politely say, oh, no, they do not. Okay, the handbook actually was based on residual income, not debt to income ratios.
So how is the interest rates on VA loans?
If interest rates on VA loans, Randall, if you take same credit criteria, same credit profiles, are among the very lowest on the planet. Okay. I'm not a veteran, and I am saying that the VA loan program, that home loan benefit, is the best loan program on the planet, bar none. Okay. And if a veteran happens to have any disability ratings, then they also get a waiver or an exemption on their property taxes as well.
Oh, wow.
And they can also, and they can also have an exemption on the funding fee as well. So now you're looking at a program where you don't have to pay property taxes, okay? And you also don't have a funding fee and you don't have mortgage insurance. The most recent VA loan that I did was a purchase up in Park City at $1.45 million. The veteran put zero money down, okay? Not a dime on this thing, okay? And he'd sold the property in Park City. He was exempt from the funding fee because of a disability, and he also got a waiver on his property taxes, okay? And
That's
if we
awesome.
tried to qualify him on this, okay, he didn't qualify based on DTI ratios, but residual income calculations he did. So he was ecstatic.
Awesome.
Yeah.
Yeah, that's really cool. Yeah, thank you so much, Lauren. You're always a wealth of information, and I love what you share with us. So if you're watching here, and it looks like we're pretty much glued to this, but you should be able to realize that you can cast a pretty wide net. That if they've got decent credit. I mean, what did you say? High, medium, and even low credit. We can qualify. If they're citizens, we can qualify them. If now Jeff said that Thomason said I was blown away by the number of loan programs in the chat, and I mean, there's a ton there. And so, Lauren, you're an amazing guy, and I appreciate your sharing your wealth of wisdom with us. And wow, I mean, I'm glad I recorded it. Like I always end up forgetting that. And maybe 2 minutes in before you got into programs, I was like, click that record button. And I'm so glad that I did. We have maybe a couple minutes for questions. If anybody has a question they'd like to ask Lauren, just unmute yourself.
I got a question, Lauren.
Yeah,
I'd love to teach what I've learned to my clients and make a post of, the different options available.
yeah.
Is there a way that you can send me the presentation, so that I can, use some of that info to teach?
You're going to get a copy of the video of this. Like I recorded the
video. Okay.
Cool.
Yeah.
And I will also, Randall, I'll send you, let me put a couple disclaimers on the actual PowerPoint. Marco, if we're going to have anything that we're doing with public or audiences, let me put a couple disclaimers and just captions on there, and then I'll get that out to everybody so that you can use it. Keep in mind that this is designed and geared towards real estate professionals. So there are certain things on here that really aren't consumer focused as far as disclosures that should be there from a legal standpoint, but I'll do this up in a way that you can use it as a real estate professional.
Yeah,
okay,
what
and
would be
share with your clients.
or any other idea? How do we convert this information and post it, out there?
Yeah, what you could do is take snippets and just happy to give you the slides and the PowerPoint, and then just take the verbiage, and I would do posts on it and just say, hey, did you know, right? This is available. Hey, did you know? You may have thought this, but really there's this.
Right.
And that way, so then you'll have the foundational background without putting the exact slide up and saying here, because at that point, the DRE gets really upset. Okay, and you don't want regulators chasing you. But if you say, frame it from the standpoint of, did you know, or are you aware of this program exists, right? Contact me so I can put you in touch with somebody that can, look at those options for you. That would be a great way to do it as well. Do a video online just with social and say, hey, did you realize that there's an I-10 program, or did you realize that there's an asset-based program that does this, this, and this? The community lending one that we spoke about, the no income, no employment, that's one that most people are not aware of. And that's when somebody hears no income and no employment, the first thing they think of is 2008 with Countrywide's liar loans, where you put it, where you said, here's what I make and here's my assets, their stated income, stated asset, negative AM, pay option arm stuff. That's what a lot of people who are around will think about. So that program in and of itself will get you a lot of people saying, hey, tell me more about it, especially because it can be used for purchases, rate term refinances, and cash out refinances. And what you're going to see happen, and my fear is that even though our homeowners have a lot of equity locked up right now, with consumer debt becoming as high as it is, and with savings becoming as low as they are, and if people start having problems on the job front, which a recession tends to do, right? Then qualifying for loans and doing, if they have to do cash out refinances or restructure their debt, it's going to become even more difficult for them to do. This program can be one heck of a lifeline. And so this one, when you talk to people about it and say, hey, did you realize that there's a no income, no employment loan that you can use to purchase, refinance, or do a cash out refinance? Most people don't even think, they're like, what do you mean no income and no employment? What it will do, whether they use the loan or not, and it's not about saying here, you have to use this one. It's about opening up a dialogue with people so that you can start uncovering what are their pain points, or what can you do to help them, right? Who can you put them in touch with that can help mitigate some of what they're going through? Sometimes it will end up being a loan, sometimes it won't. Sometimes it might be a sale or a listing, sometimes it won't. But it's being that advocate and that consultant and presenting these different options that people haven't heard about that opens up that discussion and that dialogue. That's how I would use the information.
Perfect. I just had a question. Somebody asked, what do you think is going to happen in the first quarter of 23?
First quarter 23, I'm looking to see interest rates come down to, right, depending on what you look at, we're anywhere between mid sixes and we got as high as low sevens, okay?
Yeah.
The servicing spread on loans, or the difference between the 10-year and mortgage interest rates, hit an all-time high at the end of the year. It was 300 basis points on average between the 10-year and what mortgage rates were. Traditionally, that number runs anywhere between 150 basis points and 200 basis points over a 50-year average. I am expecting to see by the first half of this year that we're going to be down somewhere around in the fives, low fives, high fours
Okay.
is kind of what I'm seeing and what I think has a possibility to happen. We will see the inflation numbers have come down a little bit because we've just dropped a couple of the higher months. There's another lower month that's going to drop off here when the next round comes out. So we may see it pick up a little bit, but then I think we will also start to see it come down a little bit as well again. The Fed, though, with what we're seeing from some other economic numbers, I expect them in these next meetings to increase rates again and again and again. I don't think we're going to see them pivot. If they pivot, which they will pivot, it's not a question of if they'll pivot, it's when will they pivot. I would expect to see that towards the second half of the year, because they're going to find out that they keep referring to employment and they keep referring to the job market is strong and employment's doing well. The only challenge with that is that employment and labor numbers are a lagging indicator. Those are the last ones to fall. After everything else has gone down and imploded, that's when the employment numbers go down. You're already starting to hear some of these big corporations are having layoffs and downsizing. Granted, I think it was Amazon was laying off 17,000, which is in their employee base is not a big number, but 17,000 people is still a big number. Okay. Sure. And so there's going to be more companies that you start seeing that happen, but the Fed is still looking and saying employment numbers are doing well. They also looked and said that holiday spending was doing well as well, and that the consumer was in good shape there. We know how the average consumer paid for Christmas. It's on credit cards.
Right.
Okay.
Yeah. It lies, damned lies, and statistics. But, the part of the issue, I think, is, the only thing the Fed can do by raising the interest rates is cause unemployment. That's how they tame inflation.
Yep.
And so if the employment numbers are high, inflation is also high. And I think, how do I say it? The mortgage interest rates are probably the biggest stake, in the heart of our business. However, you've got, like, if our business was a vampire, a stake through the heart is going to kill it, right? But at the same time, garlic and holy water can have a pretty negative effect too. And the garlic is the fact that wages have only gone up 13% over the last 3 years, and inflation's real inflation with the 1990 matrix is probably around 50%. And so, that something's got to happen. I mean, we need to come from 11 or 12 times earnings back into the normal range, which is usually, around 8, I think. So,
yeah, if the historic trends that we've seen in that relation between earnings and home values or sales prices is to stay intact, then you're right. There's a correction, there's downward pressure on values that has to happen to get it back, if that established relationship is to continue going forward.
sure.
Now, some have said that we're in a new era, we're in a new time, that relationship is not, is not going to be the same as what it was. I don't quite believe that yet.
Was
probability.
it Mar that said that?
I'm not going to say. It's sort of like Fibonacci levels in the financial world, right?
Sure.
Certain things become very predictable and certain things tend to repeat themselves. That relationship between median incomes and values has long held and been a real constant. I'm of the camp that thinks that will probably continue to stay relatively intact going forward, which again would mean that we do have some downward pressure still on values. I think my personal opinion is that unlike 08, where it was an across the board, every nook and cranny in the country got clobbered, I think this is going to be more on a sort of micro basis, that certain markets will be affected more than others. So I don't think it's just a one size fits all.
Very, very good. Arlene, you had a question.
Yes, I have a question. Can you hear me?
Yes.
Yeah. All right. Thank you very much for the information. It's a wonderful class. I'm learning a lot. But actually, I have today a client. He called me. He's a small investor, but he wants to go scale. He wants to go to another level. He's He said he's ready to invest in a multi-family, I mean, more than 5 doors and a hotel, things like that. And right now he's trying to get all the information. He was asking me if, you know, for commercial loan, so you as a lender, so do you look for people that, you know, the buyer DTI and credit or their ROI? So what is your look? What is your focus? So where he needs to apply for a loan right now? He the lender, I mean the seller is willing to finance only part of the purchase of that property, but he needs to come out with the 70% or something like that. He doesn't have that amount. So he needs to look for, you know, somebody that can help him.
How many units is the property?
He say he is more than 1 million, something about, yeah, this more, definitely it's more than 1 million,
how many
2 million,
apartments?
something like that. How
many apartments is it?
I don't know. He called me this morning, so I need to make more question, but he said the only thing, the information that I get is about 2 million, less than 2 millions.
So
and he doesn't have that amount.
Did you get Lauren's phone number and maybe have him call? Let me go over the specifics.
Yeah, I would like to have an you know, I can bring my client with you, so we can have discussion.
So depending on how many units it is, he may fit into one of the DSCR programs that are out there. And so that one's not going to be traditional financing. Agency financing doesn't work for him if he's buying more than 4. Okay. You can get, if it's an 8-plex or something like that, then there are some DSCR programs out there right now that are on the small cap commercial side that would work for him. And that's going to be based on the cash flow of the property, not his personal income. Okay.
Okay.
So it'll be down payment. Interest rate will be based on his personal credit score, but it's going to be based on the cash flow of the property. And depending on the investor that's used, he may be able to close it in an LLC as well.
Oh, okay. Yeah, he might, because he already have properties. He have a duplex, 4-plex, and a single family. So he wants just to go to another level. He is scale his business right now.
Good for him. That's awesome.
How can I get your information, your phone number, so I can call you?
Phone number is 801-550-0868. And if you want to shoot me a text, then with your email, I'll email you back with all of my contact information.
Okay, let me record back again. 801-850.
No, 801-550-0868.
Okay, thank you very much.
You're welcome.
I'll pull that up on the screen again here, so that we've got that, and I'll share that with everybody so that you can write it down if you didn't. I highly suggest that you do. There just aren't very many loan officers as qualified or mortgage brokers as qualified as Lauren is. And it's just right there. So 801-550-0868, and or email them at laurenhomeloans@outlook.com. So,
and then Randall, I will also get you an updated PowerPoint.
Okay.
That you can send as well. Let me put a couple disclaimers in there on it. Okay. And then we can release that out as well.
All right, we'll do it. Okay, well, thank you, everybody. It's good to see you here, and I know I learned something. I learn something every time Lauren talks, and so it's who's that guy back in the 70s or 80s? You know, when E.F. Hutton speaks, everybody listens, and
that's you, Randall. That's you.
Yeah, no, I learn something every time I hear you speak, Lauren. So thank you for your time, and we appreciate that. And thanks everyone for being here. And we'll
thank you everyone for the opportunity. Thanks for having me again, Randall. It's my pleasure.
You bet. Have a great day. Bye.